Coming up in today's show, stocks finish sharply lower and end their 9-day winning streak. Option traders continue to chase the market. Why Harry Dent says we're in for a big crash next year. Treasury yields finish lower. Oil finishes higher. FedEx stock plunges. And the eerie similarities between Citigroup shutting down debt trading and Bear Stearns back in 2007. Welcome back to the Click Capital Daily Market Show, everybody. My name's Jared. I'm going to get you all up to speed on everything that's happening across global financial markets and give you the 10,000-foot view of what all the themes and trends that are developing out there. And so today was the biggest bearish day we've seen in quite a while. Quite a bit of bearish breadth that accelerated into the close with some big falls in the semiconductors, utilities, consumer staples, and financials. And just looking at the daily chart of the S&P 500, finished the day at almost 1.5% low, and that's the biggest fall we've had since the 21st of September when we fell 1.64%. And like I've been saying recently, we've got these big bearish divergences starting to show on my indicators, as well as my reversal signals indicator starting to fire off, just putting the third day in a row here. And this looks like the start of a potential reversal in this zone that I'm calling the all-time high resistance zone, where the market could consolidate and make a turn lower. And just taking you down to a 5-minute chart, we're actually trading higher even after lunchtime. However, come 2 p.m, things took a turn for the worse, and we went into a bit of a waterfall sell-off, which accelerated right into the close. And that was pretty much the story across the board. Just looking at a composite index of the Mega Cap 7, they actually reached all-time highs this morning, and that came off as well. And the Russell 2000 looks to have potentially turned off a resistance zone and finished down 2.3%. And look at that, the VIX index could be starting to wake up here, up 9% today, almost getting up to 14 handle. Still really low relatively speaking. And volatility risk premium, VRP, has been steadily climbing these last couple of weeks. Now 5.57 points of premium over realized. And if you remember, just like I pointed out on Friday, the VVIX index, that's the volatility of the VIX index, actually popped up on Friday, gave us a little bit of a heads up clue as to what happened today out there. But stick with me because I'm going to run you through some news research and analysis, and then we'll come back into the charts and I'll show you what else I'm seeing out there. And I've got an interesting one for you today because I'm going to show you some parallels between price action we've been getting recently in the market and could be similar to late 2017, early 2018. Not to mention a headline I saw today that also reminded me of Bear Stearns back in 2007. But before we get into all of that, let me just quickly tell you about my Christmas special I've got available just for a few more days. And so in this video, like I do every day, I'm going to be analyzing the markets for you using my custom indicators on TradingView, which I've developed 22 of them over the last couple of years. And so I don't really use any of the free indicators out there that most people use. I've developed all of these to be improvements on them and give us some insights and visualizations of markets that we just can't get anywhere else, including some fundamental indicators like stock fair value, business quality score, and other things like the institutional buying percentage indicator. So if you'd like to get lifetime access to all of these 22 indicators, including any ones I develop in the future with no ongoing fees, then head on over to my website, clickcapital.io/Christmas, and you can get all of them, plus my latest investment presentation report, and save over $200 off the normal price, just a one-time fee of $249. So click the link below this video if you're interested in learning more about that. Okay, so getting back to the daily show, we've had quite the bullish run-up and consensus this last month and a half, and pretty much investors as a whole have come rushing back to the market as nothing changes sentiment like price. And we're still seeing these headlines like the AI fuel bull market and stocks could run for another 10 years. We've got a Bank of America survey showing investors haven't been this bullish since the start of 2022. That was right at the peak of the market before it fell. And that's largely due to the hopes of a Goldilocks economy, where inflation comes down, the Fed can just lower rates softly, and growth still holds up without anything major breaking. And a lot of investors and fund managers pointing towards AI and other things to say that the record yield curve inversions don't matter and that it's different this time. And we're seeing that with a pickup in consumer sentiment and consumer confidence surveys as well, as we've had those falls in the oil price up until recently. A lot of us be paying a lot less at the pump, which feels pretty good going into the holiday spending season. And so optimism in the economy and the stock market has been coming back to records. And nowhere is that more evident than in the options market. If you've been watching my daily show, you've been seeing how lopsided it's been for a few weeks now, with the volume of calls versus puts. And now we've got option dealers needing to hedge a record amount of upside exposure. That's because when more and more people buy calls, all the major option dealers in the market keep their books delta neutral. So that means when they sell a call, they'll immediately buy the stock. So they're just profiting from the difference between implied volatility that they sold the options for and the realized volatility by the time the option expires. And they're not taking on any directional delta risk. And so this can add to upside melt up, grinding higher. However, just like we saw in early 2018, when that changes, it can change quite quickly. Kind of think of it like a wave that it builds up and builds up slowly, then it hits that crescendo and then comes crashing down. On the other side of the coin, we've still got a bunch of cautious bears out there. One of them, JP Morgan's top strategist, Marko Kolanovic, says cash looks better than stocks next year because the Fed won't cut rates rapidly as the market is expecting. Going on to say, even in an optimistic scenario, we believe upside is limited for risky assets. And he could be right, the market may have got a little ahead of itself, pricing in a soft landing and lower rates. Other strategists are saying the S&P could tumble 20% this spring, then surge to a record high by the end of next year, even if we do get the recession. Saying it'll be quick, it'll be over really fast because the Fed will cut rates and then things will bottom out pretty quickly, which very well could happen. The Fed is much more responsive nowadays than in the past. We saw that in COVID, we've seen that with their rate hikes, going after inflation, and the Fed put will always be there. So if things come diving down, you can bet your bottom dollar they'll open the window up and flood the market with liquidity again, and we should at least get a good bounce once that does happen. We've got some going a step further, like market historian Harry Dent, who's saying there's still an everything bubble across stocks, crypto and housing, and it's going to burst next year. He's actually expecting the greatest crash of his lifetime and economic pain in 2024. Pointing to excessive government spending has driven asset prices to dangerous, unsustainable highs, and he's making quite the big call, saying this crash is not going to be a correction, it's going to be more in the 29 to 32 level. And anybody who sat through that would have shot their stockbroker. He's referring to the huge crash after the run-up in the stock market in the roaring 1920s. It all came collapsing down going into the early 30s, causing almost a decade-long recession and depression, unemployment rates getting up over 20%, and a lot of everyday people having to go into soup kitchens just to eat. And who knows, maybe he's right, because when I saw this article pop up on my screen today, it just reminded me of something in 2007, which I'll show you soon. And this is Citigroup, one of the biggest banks in the world, exiting distressed debt trading, which has been an area that has already been struggling for a while. It's also shutting down its municipal bond business. Now on the surface, that doesn't look like a big deal. However, it could be a case of where there's smoke, there's fire. And as soon as I saw that headline, it reminded me of something I saw 16 years ago that was kind of no big deal at the time, kind of came out of nowhere. And that was back in June 2007 when we got news that Bear Stearns, one of the biggest investment banks on Wall Street back then, was shutting down two big hedge funds. They were active in the mortgage-backed debt space, similar to what Citigroup has just done. And looking back in hindsight, that was a definite indicator of things to come, because a little over a year later, one of Wall Street's biggest and oldest investment banks, Bear Stearns, went bankrupt, wiping out all of its equity, and along with Lehman Brothers, set off a global financial crisis, which shook the system to its core and caused the US government to come in with a record bailout program to help stabilize financial markets and economies around the world. And I'm not saying Citigroup's going to go under, they probably won't, but it could be a sign of things to come, because at a minimum, we've got one less trader and financier of distressed debt, which further sucks liquidity out of the market. So looking back in history, when the Fed does its last rate hike and the economy goes into a recession, which it almost always does a year or two after the Fed has finished hiking rates, normally the stock market will reach all-time highs in between that. And we've almost just reached all-time highs in the S&P 500. The NASDAQ and the Dow has. However, some are saying this time could be a little different because this cycle is decidedly different than any we have experienced for the last several decades due to the overhang of higher inflation. However, like I said, we just hit all-time highs on two of the three major indices. S&P 500 just came within an inch of it. But even the Fed themselves are not saying they are definitely done. That's why we've got respected economist Mohamed El-Erian saying the Fed is bad at communicating and it's confusing people. Because the Fed last week signaled rate cuts for next year, sending the markets on a rally. However, this week we saw several Fed officials saying the markets are getting ahead of themselves, trying to dial back the dovish speak. But that doesn't matter though, because the markets are convinced the Fed is going to start cutting, and they're going to start cutting soon. Over 80% chance they're going to cut in March, with the market forecasting Fed funds rate be at 3.75% by this time next year. And thanks to oil, we have been seeing inflation around the world continue to move down. And along with that, Treasury yields as well. And just looking at the price action in the US government 10-year yield, that looks like the market's saying there's some real economic weakness coming. So only a month and a half ago, we're pushing up against 5%. Here we are at 3.85. And even though we have some big indicators out there like the yield curve, debt defaults, and money supply, all pointing towards the likelihood of a recession next year, overall the US economy has been holding up pretty well. And I'll just run you through a bunch of economic indicators on the charts. The first being the leading economic indicators index, which is holding up. The Chicago Fed Financial Conditions Index, which has actually been trending down, which means financial conditions have been improving. Along with the Fed Financial Stress Index, which hasn't really been spiking like we saw back in COVID, and in a big way going into the GFC. High yield spreads, amount of premium high yield bonds are offering over treasuries, actually getting down to lows. High yield bond market's really not worried about what's going on. We are seeing a bit of weakness in durable goods orders, and sales of heavyweight trucks actually holding up there. And the big one, the unemployment rate, still really low, 3.7%. It's highly unlikely we won't get a recession until this moves above 4%. And it's almost impossible for this to go back to 5% without us getting a recession. And that's because a lot less jobs, a lot less discretionary spend in the economy, and businesses and everyone else tightening their budgets. So we still have some signs the economy is holding up for now, like the jobs market, retail sales, and truck shipments. But we still have a lot of other signs that a recession is coming, with the biggest ones being the yield curve and money supply. Just moving on to commodities, we got an uptick in oil today, as we've still got some big disruptions in shipping in the Red Sea. After big shippers have suspended shipments through the Red Seas, and having to take a big detour around the bottom of Africa, making supply chains more delayed and expensive. However, the US military and its allies is responding to that as we speak. And what's really been the dominant factor in the oil market is US crude exports, hitting a record high, exporting almost 4 million barrels a day in the first half of this year. That's up 19% from the same time a year ago. And so that's given us a bit of an uptick in gas prices right in the midst of the holiday season when a lot of Americans are hitting the road, visiting family and friends, with the average price of a gallon now at $3.09. And there is some cracks in the unity of OPEC Plus. We can see that with Russia, like usual, doing its own thing, going against its pledge to OPEC Plus to cut back on production and export. And they've actually been surging over the past month, reaching 3.28 million barrels a day. And so what they say and what they do are actually two different things. So we've had a little bump up in the price of crude this last week from those mid 67s, just briefly touching the 50-day VWAP today above 75 a barrel. And unless we get a real spillover in the Middle East, something major happen, it'd have to be like Iran themselves entering the war. All these little militant groups shouldn't cause any real major material disruptions to the global crude market. And what's going on in the Red Sea should likely be resolved pretty quickly. And looking at global bond markets forecasting economic weakness around the corner, kind of hard to see oil getting above $80 a barrel anytime soon, unless, like I said, we get a real ignition of some major conflict coming out of the Middle East, which still has a little over half of the world's oil supply. Alphabet Google was the only real major stock to finish higher today, actually reaching new year-to-date highs. That was back on a report that Google plans to reorganize a large part of its advertising sales unit. And so the market's getting excited like it often does when these big companies may lay off workers. Apparently that could mean 12,000 of Google employees. And that's a trend in tech and probably a lot of industries for some time to come, as a lot of these jobs done by humans are starting to be done by AI and machine learning when it comes to their ad business. And we can see that in the price action today. It shot up to new year-to-date highs, almost 142, but then came back down with the market, and we put in a bit of a shooting star candle formation there. Another bad sign for the economy is looking at key transport businesses like FedEx moving around goods. There's an economic indicator of how much activity is taking place, and they just reported earnings today, coming in a little lower than expected and sending the stock sharply lower, 12%. They reported earnings per share of $3.99. Wall Street was looking for $4.19, and they lowered their forecast going forward for sales. Prior forecast was looking for flat sales next year. However, that has been revised downwards. So typically in a roaring economy, you'll see businesses like FedEx growing sales and doing more business, but instead they just lowered their outlook, and that came as a bit of a shock to the market. You can see price of FedEx been rallying quite hard along with the market, and there was quite the hard correction today for a company of this size, down 12% on huge volumes. Moving on to economic data we got out today. Got inflation data from the United Kingdom coming in a bit weaker than expected. Headline 3.9%, a bit lower than 4.4. Still got core inflation like the States, 5.1, and actually saw a little deflation month over month. And so that helped bring global bond yields down. And there's the consumer confidence from the States coming in a bit higher than expected, 110. Looking out tomorrow, we'll get some GDP data along with jobless claims. And going into Friday, we got GDP data coming out from the UK and some Spain and Canada, along with the PCE price index, personal spending, and durable goods from the States. Still a lot of people long stocks out there. They haven't got out just yet. We only had one down day. Still got the fear and greed index elevated at 72. But corporate insiders haven't been as excited as option traders. Actually been doing a lot more selling over this last week than they have been buying. And just looking at S&P 500 futures, my institutional buying percentage indicator is actually in the bearish zone, with S&P 500 oscillator still overbought above 60. And stick with me to the end of this video. I'll come back to the S&P 500 at the end and give you my final thoughts. And just looking at the amount of stocks and ETFs breaking out to 52-week highs, S&P 500 and NASDAQ and Russell both did that this morning, along with Amazon, Google, Meta, Coinbase, Netflix, JP Morgan, Boeing, MasterCard. Other side of the coin, we had 68 stocks and ETFs breaking down to 52-week lows. Still a bunch of Chinese name, the Hershey Company, and not too many other large caps, as we still been trading pretty high this last month and a half. Bit of a sharp turn down in breadth as measured by the amount of stocks above the 20-day average. Still quite elevated there. And same with new highs versus new lows. Still quite bullish there. And looking at my sector trends table indicator, just with today's late afternoon move, we've got all but one sector, communication, underneath their 5-day moving average. Got a bit of a pop in the VIX one day, 15.2. Option dealers saying we could get a bit of volatility tomorrow, but still a normal VIX curve in contango with longer dated duration options, 3 and 6 months, still quite a bit higher than the VIX 30-day. Interesting today was a bit of a move down in the spread between bond market volatility and stock market volatility. And believe it or not, we've still got a low put to call ratio. It's quite a busy day in the options market for a Wednesday, 47.8 million contracts, and still the majority are call options, 53%. These lower yields have kept TLT ripping higher, and the dollar's looking to find some support here at 102. And Bitcoin is looking primed for another breakout. This thing is holding on to its momentum really good. Hasn't done so much as a pullback to the 50-day VWAP for a few months now. And there's commodities as a whole breaking down to new multi-month lows, with gold still consolidating just above 2,000 an ounce. International stock indices close a bit earlier than the American market. However, they all fell a bit on Wednesday, including China, breaking down to another 52-week low. There's high beta stocks looking a little toppy versus low volatility. Over to stock sectors, the only sector finishing high today was the shipping ETF. The next best performer was communications and energy stocks. Worst performing sector was clean energy, biotech with a sharp reversal, and ARC Innovation, those highly valued stocks having a little bit of a turn down. Bit of a sharp fall in NVDA, down over 3%, and Tesla as well, down almost 4%. AMD looking a little toppy, and the high beta meme stocks all getting hit a bit hard today, and some healthy pullbacks in those old economy stocks we've been watching as well. And the regional banks continuing to remain a bit volatile, along with the large cap banks as well, looking to catch their breath after this huge run here. Okay, so looking at the S&P 500 today, another thing in the last week that this price action has been reminding me of is in late 2017, the market was just ripping higher and higher, had everything going for it, liquidity, low rates, low inflation, business profits improving, huge bullish consensus, and a huge amount of people selling options and shorting volatility. A lot of electronic traded notes sprang up, all with shorting volatility. A lot of people jumped on board of that trend as a new paradigm, easy way to make money in the markets. And then so we ripped up right into early 2018, and just like a wave in the ocean, it started to turn and then hit a crescendo, and the market had a little mini crash. Not a big one by any historic proportions. That was enough of a move there to wipe out a lot of those short volatility products, traders and funds, causing some huge losses out there. Because just overlaying the VIX onto this chart in the orange line, just like now, it was really low, around 10, 11, 12, and in just a week and a half, it shot up to 37. And that's what really wiped out those short volatility products. And a lot of people calling this period of time Volmageddon. So here we are now, and whilst it hasn't been gone as long as late 2017, there's a similar price action of that grinding higher, low volatility parabolic rise, with the VIX coming down really low. And the longer we stay here, the more of an uncoiling we're going to get when it does happen. It may be happening now, it may not, because what happens is so many people get pushed into a corner and they become vulnerable. And just like a fire in the room, everyone tries to hit the exit at the same time. That's why we get those big, short, sharp spikes that are a feature of modern day markets. So if we did fall from here, that would be a clean reversal signal we've got, stalling out in this big resistance zone, the bearish divergence on my hidden divergence. My DSI was really elevated just yesterday, getting up over 21 on the SP, and my reversal signals firing off. We finished really weak here today, and just looking at breadth and positioning in the market with call options, there is quite a bit of room to fall, and there is the potential for some nasty red candles to follow. The setup is there. I'm not saying it's definitely going to happen, just saying we've got the ingredients for that to happen, and it could be exacerbated going into this low liquidity period in the markets around Christmas, where we can sometimes get some funny moves and other things happening out there, which were, if it were the case, could make for an interesting Christmas period in financial markets. And the headlines will try to attribute it to fears over a recession or something like that. It's really more to do with positioning, technicals, profit taking, people hitting their stops, and everyone trying to lock in their profits and get out at the same time. We'll just have to wait and see what the last 2 days of trading before Christmas brings us. That's all I've got for you today, guys. And just as a reminder, if you want to get lifetime access to all my custom trading indicators for TradingView and my latest investment presentation, head on over to my website, clickcapital.io, click on the red Christmas banner, and you'll come to this page. All you need is a free account at tradingview.com. Just enter in your email address, your TradingView username, safely check out with Stripe, and you'll have lifetime access with no ongoing fees to all of my custom indicators that I use to manage my portfolios myself every day. And I do have some really cool ones that I'm developing and going to be bringing out early next year, which you'll also get free of charge as part of this package as well. So this is one of the lowest prices you'll ever see me sell my indicators for. So if you've been thinking about getting them, I highly recommend taking advantage of this deal, expiring in the next couple of days. Thanks again for tuning in to the Click Capital Daily Market Show. My name's Jared, and I'll see you again tomorrow night. Cheers.